Thanks everybody for joining. My name's Alex Maslak. I'm the Director of Business Development at Laurel Road. And Laurel Road has partnered today with MinorityNurse and DailyNurse publications to provide a little bit of guidance on student loan repayment in this ever-evolving marketplace. So I'm sure you're familiar. There's been a lot of change in the student loan world since COVID happened. So we're going to cover what that change is, what's coming up very rapidly now in terms of new changes, and how you can position yourself to take advantage of some of these opportunities. So I have been at Laurel Road. My name is Alex Maslak. I'm the Director of Business Development. I've been here for almost 8 years. I've been in the student loan industry for over 10. And I do all of our educational presentations at Laurel Road. I've some background in the federal student loan industry, as well as what we do here at Laurel Road with private student loan refinancing. So hopefully can help provide a little bit of guidance on the industry as a whole and different options you have at your disposal, be it those federal repayment programs or refinancing with a private lender like Laurel Road. So we'll start today by covering some of the changes through the CARES Act, recent announcement by President Biden as it relates to forgiveness, and then delve into some traditional federal repayment programs like income-driven repayment, public service loan forgiveness, and compare and contrast federal repayment versus private loan refinancing. And that's what we do at Laurel Road. So the idea when you refinance a loan is you'd come to a private lender, so we're a bank, and we would evaluate your creditworthiness. So looking at your income, your credit score, your total debt, and based on those factors, we would make you rate offers on your loan. So if you liked the rate offers, you could effectively, we would effectively pay off your existing loan or loans and give you a new loan at a lower rate. And there's no cost whatsoever to do this. We just pay off exactly what you owe. We give you this new loan, just comes with a lower interest rate. So there's some pros and cons to doing that, which I'll cover today. And the goal by the end will be, sort of figuring out what is your optimal repayment strategy. There's no one size fits all approach to paying back your student loans, especially with all these federal components. So starting to figure out which of these paths is best for which type of borrower. And we do have the Q&A and chat functionality enabled here today. So to the extent that you had questions, feel free to type them in. I'll try and pause every few slides, answer questions as they come in. Want this to be as interactive as possible. And so I'm sure you've realized that for the last almost 3 years, you have not been making payments or been charged interest on your federal student loans. That was a result of the CARES Act, which passed right when COVID was starting, to give borrowers around the country some relief on your student loans. And so, as it relates to student loans, federal loans have not charged you interest, so you haven't accrued $1 of interest, nor have you been obligated to make a payment since March of 2020. Originally, that was just supposed to run until September of 2020. It got extended 8 times over the past 3 years via executive orders. Sort of just kept the can kept getting kicked down the road, so to speak. In President Biden's most recent announcement this past August, though, he was explicit in saying, we are extending this one more time, and then student loan payments and interest are going to turn back on January 1st, 2023. So, just over a month from now, your federal student loans are going to turn back on. You're going to have to start paying them again. You're going to be charged interest again. So, some nice relief during, the height of COVID, but sort of returning to normalcy now, and those loans returning to a payment status. I would note that those of you who are pursuing public service loan forgiveness, these months, these 3 years effectively, do count as progress towards forgiveness. So, if you're planning to have your loans forgiven in 10 years via PSLF, these 3 years of quote unquote $0 payments will count as progress towards those 120 necessary to achieve forgiveness. So nice benefit there for those working in the public sector, and nice benefit overall for the loan holding population. Was included in this announcement from the Biden administration in August. So the bad news, so to speak, is that loans are getting turned back on. You're going to have to start paying and being charged interest again on your federal loans. The good news is, we finally got some clarity on this much talked about forgiveness concept. And so, what was announced is anybody who's earning less than $125,000 a year, which many of us are, if you're earning below that, you can have up to $10,000 forgiven on your federal student loans through this, wide sweeping forgiveness event. The deadline to apply is actually next December, so you've got over a year to apply to have these loans forgiven. But nice to finally get some clarity on this. It's been talked about, are they going to forgive 10,000, 50,000, all of it? I think good for everyone to get an answer to that. And would also just note, if you're married, the income threshold is double. So 250,000 for married couples. As long as you're earning below that, you can get that 10K forgiven. You can actually, if you took Pell Grants while you're in school, get up to 20,000 forgiven. So keep an eye out on that if you did take Pell Grants while you're in school. And then the last part of this announcement was a proposal. So the first 2 bullet points on here, executive order, the Biden administration has the power to enact these without congressional approval. The last bullet is a proposal. And so this needs to go in front of Congress. They are going to vote on it. But the proposal entails making income-based repayment more attractive. So right now, if you're in income-based repayment, you are paying at least 10% of your income each month towards your loans. If this proposal were to pass, there'd be a new income-based repayment program rolled out, and it would ask for only 5% of your income to go towards the loan. So effectively cut your monthly payment in half if you're using one of these IDR programs. So again, proposal still needs to be voted on, remains to be seen if it gets passed. My recommendation on the federal side of things, keep a close eye on the legislative ongoings. These programs seemingly constantly are changing. So if you're utilizing them, just be prepared to change as they do as well. Some terms to know here that will get mentioned throughout the presentation: consolidating versus refinancing. So consolidating means you're just lumping all of your loans into one big loan with the Department of Education. Doesn't change your interest rate. Just simplifies everything. You now just have one loan instead of many. Refinancing, that's what happens when you go to a private lender like Laurel Road and we pay off your loans and we give you this new loan at a different interest rate, presumably lower interest rate. Oftentimes it does simplify things, is that you can lump your loans together and just have one refinance loan. But the main difference here is refinancing changes your rate, consolidating does not. And then fixed versus variable rates. So fixed rate loans stay the same rate the whole life of the loan. Variable are going to adjust every quarter or every month based on the economic interest rate environment. So variable are going to go up and down. Fixed are going to stay the same rates. Majority of borrowers in this rising rate environment are taking fixed rate loans. But when you refinance with us, you will have that option. So you could take a variable rate if you thought rates would go lower in the future. And deferment versus forbearance. So both of these are non-payment statuses. Effectively, you don't have to pay on your loan. You're in agreement with your lender that you're not paying anything. Deferment is when you're in school. Forbearance is post-graduation. That's the option if you wanted to skip payments for some period of time after you graduate. So some questions to be asking yourself as we move through the presentation. First step of identifying your best repayment approach is figuring out what types of loans you have. What kind of educational debt is this? Is it from undergrad? Is it from grad school? Is it federal? Is it private? How many loans are there? What are the interest rates? Who are the lenders? So, first step for almost everybody is to do a little bit of self-diligence, so to speak. Figure out your individual situation, figure out what loans you have, as that's going to play a really important role in figuring out how to pay them back. So now I'll talk about these federal programs in a little bit more detail. I think most people generally are pretty familiar with them. They're talked about by your financial aid office quite a bit. Direct consolidation, I mentioned earlier, it's the idea that you're just going to take all of your loans, lump them into one loan through the Department of Education. A lot of people's first step upon graduation, consolidate. It's going to make your life a lot easier. You'll have one loan instead of a dozen with a half dozen different lenders. A really easy step to take to make sure you know where everything stands, and it's all under one roof once consolidated. So income-driven repayment, I mentioned this earlier. These are programs that allow you to make payments based on your income and family size as opposed to what you owe. So instead of paying based on your debt burden, which could be substantial, you'll be paying based on your starting salary or your current salary. So this basically ensures that your monthly payment isn't a burden. Your payment is always going to be aligned with your income and your family size. So there's 4 different versions currently of income-driven repayment programs, ranging from income contingent repayment, which has you paying 20% of your income, to pay as you earn and revised pay as you earn, which is only 10% of your discretionary income. I mentioned earlier, there's a proposal to introduce another program that's only 5% of income. So these are evolving like the marketplace overall, so keep a close eye here. There is a forgiveness component built in and of all of these programs. So if you were to pay for either 20 or 25 years, depending on which program you're utilizing, at the end of that time, if there's anything remaining on the loan, it's going to get forgiven. The caveat with this forgiveness is it's taxable. So theoretically, if you had $50,000 forgiven in 20 years of pay as you earn, that 50 grand would be considered taxable income. So you would, it would be as though you earned another 50K in that tax year. So just be aware of that. I mean, it doesn't necessarily negate its value totally, but it's certainly a consideration, in determining, are you best off pursuing this long-term forgiveness or perhaps, refinancing and paying the loan back quickly. Just something to keep in mind there. And on the topic of forgiveness, one that's really pertinent to nurses, given that so many hospitals are nonprofits, is public service loan forgiveness. So this program says if you work for a nonprofit or government entity for 10 years, and you make qualifying payments on your loans for those 10 years, at the end of that time, anything remaining on the loan gets forgiven, and this is totally tax-free. So if you had 100,000 forgiven in 10 years, it is wiped clean off your balance sheet. There's no tax implications whatsoever. So it's really attractive. I mean, it's about as good as you can do on your federal student loans. And there's 4 boxes to check in order to set yourself up for this. So first and foremost, only federal loans are eligible. Private loans, you would not want to refinance into a private loan if this is something you planned on pursuing. And then you use income-driven repayment to pursue public service loan forgiveness. So you're enrolled in one of those programs I mentioned on the previous slide, making your payments, and that's the way that you make qualifying payments to get to this forgiveness point. And then obviously, full-time employment at a nonprofit or government entity, it's 120 monthly payments, so 12 payments a year for 10 years, at which time anything left over gets forgiven. This is another one that gets talked about quite a bit. I think there's a lot of interest and energy behind it currently. There have not been tons of people to get their loans forgiven through this, but the percentages seem to be improving. I personally think if you're working at a nonprofit and you expect to stay there for quite a while, it's a really attractive option, and something that should be given strong consideration, especially for nurses. Again, high propensity of working at a nonprofit, given that so many hospitals are. And so, starting to get a good understanding of federal repayment programs, but how do they compare with private loan refinancing? Overall, the federal programs are going to be they're going to be more flexible than refinanced private loans. So federal loans have those forgiveness, income-driven repayments. They have a longer term forbearance available. They offer in-school deferments. Generally provide a good deal of borrower flexibility. The trade-off to that is your rate typically is on the higher end. Everybody gets the exact same rate on their federal loans when you're in school. When you refinance, your rate is based on your job and your credit history. And so a lot of nurses, given your low unemployment rates, can qualify for some of the lowest interest rates out there. And so that's basically the trade-off, is you're foregoing some of those federal flexibilities to lock in this lower interest rate. And for most people, it becomes pretty clear either, I need to use these federal programs for the liquidity relief and to get a lower payment or to pursue forgiveness, or I know I'm going to be paying this loan back out of my pocket. I just want to, save on the interest as much as I can. And for those folks, refinancing tends to be the best fit. And there are some ways that we have sort of copied the federal programs, similarities. Loans still discharged in the event of death or disability, still eligible for the student loan interest tax deduction, reported as a student loan on your credit. Interest capitalization schedule is the same. So a lot of ways that we're similar as well as different from the federal loans. This COVID interest and payment holiday has been a factor for the last 3 years. That's coming to an end, obviously, in just over a month here. So won't be a factor anymore, but has been something that has played a role in decisions for the last 3 or so years. Any questions on the federal programs before I move on? And it's okay if they're not. I know these are generally more familiar to people, get talked about by your financial aid office quite a bit. So we'll have time at the end as well for questions, but feel free to type them in as they come up. Student loan refinancing, generally, I explained the concept. It's, us paying off your loans, giving you a new loan at a lower rate. We don't charge any application or origination fees, nor are there any prepayment penalties. So this is truly free. You'll also be able to choose the term that you want. So we have 5, 7, 10, 15, and 20-year term options. You can choose amongst all of those. Generally, shorter term loans are going to have the lowest rates. Longer term loans have rates that are a little bit higher. So you're trying to find a good, comfortable point between low rates and manageable monthly payment. And this is one of the few instances where you have the opportunity to save money in the short term. Your monthly payments in an apples to apples comparison, paying the loan back over the same period of time, will go down if your interest rate goes down. But you'll also save money over the life of the loan when you extrapolate that out over 5, 10, 20 years, however long it takes you to pay the loan back. Typical borrower is saving, let's say at 100,000 in loans for a nice round number, you're probably saving $10,000 to $15,000 over the life of the loan. So it's a real savings opportunity. Again, it's not for everybody. I get asked all the time, what is the best time to refinance? When should I do this? I don't think there's a person in the world who has a definitive answer to that. Rates, go up and down. Right now, we're in a rising rate environment. Rates are higher now than they were 8 months ago. The expectation is that rates 8 months from now are going to be higher than they are now. So, what I like about student loan refinancing is that you can always refinance again in the future if rates did go down. So, if 6 months, 12 months from now, you found that you could qualify for a lower rate than you got today, you can refinance again. There's no cost to do so. There's never any closing costs. So it's very flexible in that regard, that you can always refinance again in the future if rates did go down. I've mentioned it a couple times today that your credit is a factor in determining your, number one, eligibility to refinance, and number two, what rates you get. So the higher your credit score, the better loan applicant you will be. And your credit score is it's a number which effectively measures the likelihood that you will repay debt. So the credit bureaus assign this FICO score number to everyone in the country, and lenders will look at it and consider it in determining, if you're eligible for a loan and what rate you would qualify for. So I think most people are familiar with the fact that your credit score will improve when you pay your bills on time. And that is true. That is the biggest factor in determining your credit score. But other than that, it's a little bit of a black box. The thing I didn't realize before working in banking was this credit usage level. So the credit bureaus don't want to see you using more than 30% of your available credit limit. So all of your credit cards that you have, they're going to have a credit limit on them. And so if you had, let's say, a $10,000 credit limit, the credit bureaus would prefer that you not use more than 30% of that on a monthly basis. If you were using more than that, it's going to drag on your score. So what you would want to do is contact your credit card company, explain that you want to increase your credit line. And in most cases, they'll do that. And so just that simple phone call to increase your credit line and bring it down so that you're using less than 30% of it each month can be a really easy, cost-free, immediate step to improving your credit, and one that I think a lot of people are unfamiliar with. Other factors that they look at, credit history in terms of how long accounts have been open. That's one that just typically improves organically over time. So, as you just mature in your life, you're going to have your accounts open for a longer period of time. That's going to improve your credit score. They also don't like to see tons of new applications in a short period of time. So don't go and apply for a credit card, an auto loan, a mortgage, and a student loan in the same week. That can drag down your score. A couple other direct benefits of working with Laurel Road I'd like to point out is, so for MinorityNurse and DailyNurse readers, we are offering an additional 1/4 point discount on your student loan should you refinance with Laurel Road. So let's say you're going to get a 5% rate based on your own creditworthiness. We would take another 1/4 off of that and give you a 4.75% rate because you've come to us through either MinorityNurse or DailyNurse. So really valuable discount they've broken on your behalf. It's the most lucrative rate discount that we offer any of our partners. So be sure to take advantage of that. We've got the URLs shown at the top of the screen here. We also offer another 1/4 point off of your rate if you set up auto pay, which 95% of our borrowers do. And there's no commitment to do this. So by the time I'm done talking in a few minutes, you can have gone to one of these landing pages, entered in some very basic financial information, and you can get preliminary rate offers immediately. So it just takes a few minutes. If you didn't like the rate offers, you can walk away. There's no downside. If you did, you can continue moving on through the process to refinance your loan. But there's never any commitment to do this at any point in the process. And we will honor your grace period. So if you're a recent grad, we will let you take advantage of that grace period, not start making payments for up to 12 months post-graduation. So hopefully this has been helpful. You're starting to formulate a repayment strategy. What's next? Be strategic. So if you are going to pay down debt with overpayments, you would want to do so would want to do so by paying your highest rate loans first. So typically that's a credit card, make sure that gets knocked out first and foremost before you go and pay down other things. Take advantage of rate reductions. I mentioned, what we're offering readers, but also that quarter point for making automatic payments. Take advantage of those where they're available. And then take advantage of tax deductions. So if you're making less than $75K, you can deduct up to $2,500 annually on your federal taxes in student loan interest paid. Consult an accountant on that. And to the extent that you can make payments on time, we definitely understand people encounter difficult financial situations, but contact your lender. If you're not able to make a payment, oftentimes there's payment plans you can go on so you don't go delinquent or default on a loan. So that was all I had for you today. I appreciate everyone joining. I know student loan debt is nobody's favorite topic to discuss, but suffice to say, there's plenty of opportunity out there to reduce the cost of the debt, be it through refinancing, be it through forgiveness, income-driven repayments, especially for nurses. There's a lot of opportunity for saving. So, would encourage you to do your own individual research, figure out what's best for your financial situation and be prepared to capture those savings opportunities. So any questions, feel free to type them in. We've got a few minutes here, but for anybody who has to drop, again, appreciate you joining and hope to hear from you soon. Question from the audience: does this same situation apply to doctors at government hospitals? It does. So, these loan forgiveness programs aren't just for nurses. They're not just for doctors. They're not just for teachers. They're for anyone working at a nonprofit or government entity. So, it's not profession specific. It's all about who your employer is. So if you're working for, an entity that's classified as nonprofit or the government, you could pursue forgiveness through that program. And that looks to be all the questions that I've seen come in. So happy to take any more, but again, if there's not any more questions, really appreciate everyone logging on here today.